Hey, Think Realty, thanks so much for joining us on the podcast today. Always appreciate your time, and hope today meets all expectations. We've got a great guest here in just a second, but I want to say a quick thank you to our podcast sponsor, which is CV3 Financial. When you're taking on a new real estate investment project, having a trusted lender is key. Count on CV3 for your fix and flip, rental, cash out, or rate and term refi needs. Visit cv3financial.com, cv3financial.com/Think Realty. Again, Eddie Wilson here, and super excited to host the podcast again. Founded Think Realty in 2013, if you're new to the podcast, really because I'm a third-generation real estate investor who just wanted to bring some content, information, because there's a lot of gurus around there selling their wares, and I just wanted to bring my friends who are actually doing the work into this space, and so that's what I consistently do, is bring people to you that are actually doing the work, so you can ask them questions and glean from all the work they're doing. So our guest today is Matt, and Matt Chancey is a local Florida guy, so appreciate you being on the show today.
Born and bred, thanks for having me.
Yeah, very good. Born and bred in Florida, huh?
Native. My parents, their parents, their parents, as far as you can go back.
Really?
Yes.
That's actually pretty rare.
That is, it doesn't feel rare to me because I live it, but you're right. When other people are like...
I moved into Florida 2 years ago, and I rarely meet somebody that's, that says that they've been here for multiple generations.
Yeah, and then the funny thing is everybody's like, oh, you sound like you're from Alabama or something like that. I'm like, well, no, this is because I'm actually from Florida, and everybody else is a transplant, so they don't sound like a Floridian. I am a Floridian. So
that's a good point. I moved to Jacksonville from Georgia, and I realized that Jacksonville pretty much is just South Georgia, right?
South Georgia.
Like, yeah, if you hear somebody with a real strong accent, they're probably from Jacksonville, you know?
Very true.
Well, what you do is you spend a lot of time in the tax space, and which a lot of real estate investors, they get into real estate investing for the opportunity to gain wealth, to create wealth, and what they miss is all the amazing tax opportunities that are there for them as real estate investors. But if you don't mind, just give us context, who you are, what you do, what your firm does, and then we'll start from there.
Sure, fair. So I have a real estate background. I grew up in it. I've been a general contractor for over 2 decades.
Okay.
My stepdad, who I was with for 28 years, was a builder after being a bank president. Mm-hmm. So I kind of learned how real estate was built, how it was financed. He was in the spec home space a long time ago in Central Florida, when you could do spec houses for $100,000, mm-hmm. and that made sense, right?
Yeah.
But times have changed, and I have experience in that space, but realize I don't think that was the highest and best use ultimately in my skill set.
Okay.
And so what the past couple of decades have been is understanding how to partner with large institutional real estate sponsors or developers. Mm-hmm. Not really, I wouldn't say syndicators, and that's a different,
Sure.
Syndication's a mechanism. A syndicator
Sure.
is somebody that's distributing somebody else's product on a marked up basis is the way I view it, but that's a different conversation.
We might need to jump into that, but there you go.
Fair enough, That's a deep pool, understood, right, okay. So, and then I'm kind of on the capital market side, so
Okay.
I'll go find investor pools, we'll go to big sponsors, let's say it's somebody that wants to build multifamily apartment complex, we'll bring the money to the deal and we'll negotiate a spot on the capital stack. But then the tax piece of it, where that comes from, is how we structure the partnership around the underlying real estate investment vehicle, because real estate as an investment can appreciate in value, can generate income to a combination of the two, right? Depending upon how you structure the partnership, you can have tax deductions, tax credits, passive losses, and other benefits that can flow through to your LP investors from an allocation standpoint. Yeah. You can also structure the partnerships for 1031 exchanges. You can structure them for 1400Z capital gain abatement. There's many different ways you can structure a partnership when you're doing development of real estate.
Sure, yeah, that's awesome. Thank you for the overview.
Sure.
So you have been a real estate investor, sounds like, for quite a while.
Look, I've seen it for a long time, grew up in it, right? I was roofing houses when I was 14 because I was big enough to carry plywood, right? And that's because back then they laid the plywood on the ground. You had to be able to pick it up and throw it on the roof. Yeah. Today they put that little nook on and they put the plywood on the roof,
they just
which
set
is
it up there for you.
Totally cheating.
I used to have to carry the bundles of shingles up the ladder. I did the same thing, so I get it.
You
now,
get it.
Now they have these booms. They just set it up there for you.
Yeah, that's not how it used to be. It's not how it used to be. So yeah, I've been in the business for a long time. Saw the fix and flip game. I know tons of people over my life that have done hard money and all this stuff in the residential space, and I pay attention to what's going on. Everybody's trying to move to If you could do single family, you move to duplex, you move to triplex, you move to multifamily, because now you get different types of credit or loans when you do those pros.
Yeah.
And so we've been doing it at the top of the market. I've got a bunch of sponsor relationships that we built over multiple decades. Guys that build, apartment complexes, 300, 400, 500 units. Mm-hmm. We build it with private money, stabilize it, convert it to an NOI calculation and a cap rate, and sell it to REITs, pension funds, sovereign wealth funds, split profits, GPLP structure, and rinse and repeat, do it again.
Yeah. Right now where we are in the marketplace, there's a lot of fear, there's a lot of issue, like people are nervous, right? Would you say that you're bullish, bearish on multifamily, and why?
That's a great question. So I can tell you from experience, right? So I can tell you about deals we have in and how things have worked out. So, when the interest rate spiked in 2022, the fastest that interest rates have ever moved, there was a lot of people that were looking to do a multifamily deal, value add and or development, that it really monkeyed up all their numbers, right? And we had a bunch of projects that were in the pipeline with loan commitments to be able to develop projects. And the banks, before finishing the deal, said, you know what, it was going to be 30 million of equity, 60 million of debt. The only way we're doing it is if you could bring another $3 million to the table of gap equity. Yeah. Now, the average person can't just bring another $3 million magically to the table to make it happen. Fortunately, for the size and the scale of the way we do things, that wasn't a problem. So does that slightly adjust your economics and what it looks like? Plus, the interest rates can move your cap rate assumptions, right, in the wrong way from a valuation standpoint. But the other thing that happened, and unintended consequences, is right now we're manufacturing product that will be delivered to market when there is a massive imbalance between demand and supply. There's very little supply coming to market. We have a bunch of assets coming, and so we're going to catch a premium price. And if interest rates start to move in the direction they're talking about moving, we'll get some cap rate compression. So which means we'll sell for a premium price because less product is being manufactured over that time horizon. So I guess that's the long way of answering your question, of saying, what I've learned in my career is every time somebody sees an obstacle, if you're able to pivot between asset classes, submarkets, and understand structurally what you're doing, there's always an opportunity in the obstacle if you can find it and are capitalized enough to be able to execute. You
ever read the book by Ryan Holiday called The Obstacle is the Way?
No, but I get it. I totally get it, right?
It's basically exactly what you just said.
That's right.
It's great.
That's right. Most people see a problem, and I'm but on the other side of the problem is the opportunity.
The opportunity is tied to the obstacle.
That's right. If it wasn't, there'd be a ton of competition. The pricing would be terrible. There'd be no margins and no way to make money. If it's all blue sky and all opportunity, it's going to be a terrible place to be anyway.
So we're talking multifamily, so we might as well just broach the topic that you kind of brought up, because it sounded like you're a little bit passionate about it, about syndications and syndicators. So why don't we dive into that? I want to hear it. I want to hear what you had to say about that.
So, yes, I apologize. I don't want to come from I'm, soapbox or anything, right? In the past few years, I've seen a lot of syndications. And so a syndication, for lack of a better description from my perspective, is somebody manufactures an asset, and then this group of somebody raises some capital and says, we're going to acquire that asset at a deep enough discount and add enough value to it that we are going to be able to make our LP investors money off of the carry in whatever their value add strategy is. Okay, now you have to believe in a few assumptions, number one. Number one, if you buy something that's truly value add, let's say a 30, 40-year-old property that completely needs a lot of work, are they capable of executing on that level of work? I don't know many people that will go into an apartment complex, gut every single unit in it, could fix pipes and plumbing and crack foundations and all that stuff. That is a heavy lift, right? That's not an administrative thing. Most people don't have that level of technical ability. So let's assume they buy a newer vintage property. So now you're making the assumption a developer builder that built that asset didn't know enough and left enough meat on the bone that he sold you something so that you had the ability to add even more opportunity to it to make money on that side. So that's the buy high and sell higher theory, right? I think that's foolhardy to think that can happen. I think those people are getting kicked in the teeth right now. So I don't believe, and that model is the syndication model. A whole bunch of people raised a bunch of money under the thesis that we could make something that was already being sold at value more valuable. And I think that's the wrong approach. Now, if you have the ability to really turn around distressed assets, if you were really buying notes on assets that had collapsed, which right now there's a ton of that happening in the marketplace. So today, if I was a syndicator, syndicator, if I'd have waited around with all my pooled up capital and I had a relationship with lenders that were taking back those properties, because today syndicators are walking away and giving the keys back on stuff because they don't know they didn't know what they were doing then, and the interest rates and their undercapitalization exposed them to the marketplace.
Yeah.
I'm not telling you anything you don't know. So I believe that syndicator is a person that buys somebody else's thing, slices into pieces, and tries to sell the problem to unwitting LP investors when they don't know any better, is the way I view it. Apologize.
It's a strong opinion, yeah.
Strong opinion.
Yeah.
A syndication is something that I view as where the manufacturer of the property decides, I'm going to slice it into pieces and sell those pieces at what is still a reasonable fair market value because I made money when I manufactured the thing.
Sure.
Right? And I always use a pie analogy, like when I say that. So you drive by a pie store. The person in the pie, it only takes 3 things to make a great pie, right? You need to be a top quality chef, you need some best in class ingredients, and you need a recipe that works. And if you put a pie in your window for $10 and you can sell it for $10, that means you're making a profit when you sell it for $10. And you're fine if somebody comes in and buys it for $10 and walks out the door with it.
Sure.
But if somebody walks in and goes, I don't want the whole pie, and I just want to buy a piece, you're like, well, I'll slice that pie into 8 pieces, and I'll sell you a piece of it for $2, right? Because of all the extra effort I had to go through, the materials, box it up. Well, now I'm fundamentally syndicating my own pie and making more profit on it because people want to buy individual pieces.
Sure.
I got no problem with that. The problem is when somebody drives by that pie shop, sees it in the window for $10, buys it for $10, takes it down the road, tells everybody they paid $20 for it, slices it into pieces and starts selling it off. Not a big fan of that, because that person doesn't know how to source the ingredients, doesn't know how to bake a pie, right?
This sounds like entrepreneurship to me.
I don't know. It's distributorship, I guess. Look, okay, you're not wrong. You're not wrong. But at the same time, I think a lot of the people that are having a bad experience in a syndication today it's because of the quality or the lack of quality with the syndicator that they worked with. Had they have worked with an operator and a manufacturer that used syndication as a capital mechanism, then I think they would have a different outcome.
I agree, and I think we 100% agree on that, and that's where a lot of people are getting very, very. They're taken advantage of in massive amounts. I mean, like most of the properties I'm buying today, multifamily, up to over 4,000 doors now, is somebody who got into a value-add property. They raised a bunch of money, and then they did all the work, and they're at 70% occupancy, and then they came back and they don't have the liquidity for the standards that are needed to go get long-term debt. And they're like, I don't know what to do with it. Here, you take it.
That's right.
And I'm jumping in, and because there's so much opportunity in that deal right there. If I can take it down myself, I'll take it down myself. If I take it down and I let some people in, syndicate it, whatever, there's so much room in that deal. And especially if interest rates move and cap rates compress, there's even more room in that deal, right? And so with very little work on our part, because essentially it's already 75% occupied, we have to essentially find a decent operator, which I have a bullpen of, jumps in, they get that up to 85, 90% occupied, and I'm selling it, trading it at a cap rate that's standardized in the marketplace.
But you waited until you found an opportunity from not a distressed asset, but a distressed seller.
Correct.
And that's not the same thing.
Correct.
And so today's market has a lot of distressed sellers because they were overly optimistic about where asset classes
Which is the guy you're picking on in this conversation,
That's
which
correct.
I 100% agree
That is
with
correct,
you.
absolutely. So you're right, but there's always a way to do those things wrong.
Correct.
But the problem I'd seen in the past few years is these syndicators showed up, started raising money, and then they should have sat on their hands and done nothing with all this pooled capital because there was no smart place to deploy it, and they didn't. To appease their investors, we're going to buy something, we're going to claim we can value at it, and now they're jammed up. They just, sometimes you wait.
And their investors are the ones taking the hit when they sell it to me, right? It's not them.
It's not them. Many of those syndicators had no co-investment dollars in the deal. Their only profit center was going to be on the fees they collected and the carried interest of a GP, their non-ability to non-execute.
You know what I like is the legislation that's coming out that says that a GP has to actually physically have capital in the game. You know,
they should.
And I agree. And it goes back to invest in the jockey, not the horse, right? And it's like, you have to understand the operator. You have to understand their capability. Can they actually take a really distressed asset and reperform it?
Yeah.
Like you said, that's not an easy feat. So,
no. And I saw a lot of medical practitioners in the past few years get into that space. Going, I don't want to be a doctor anymore. I'm going to be in the real estate business and put a whole bunch of money in. And now, to their defense, I did see a bunch of those doctors put some of their own capital into the deals and lose it all. So when they sucked those other doctors in and they lost their money too, at least they lost some of their own money along with the other ones.
Yeah, it's shared misery, right?
I guess misery loves company, right?
So a lot of our investors on the Think Realty platform, they've got 4, 5, 10 single family houses. And the constant conversation I'm having is they're starting to age, right? So we've been doing this for a long time. Our base is aging a little bit. And they're moving into a place where they don't really want to invest actively anymore. And they've done it. They have fixed tenants and toilets. They've moved on, tried to find a property manager to take on their assets. If syndication is a crapshoot, what passive investments are out there that somebody that's just tired of the active world, where could they look right now to find safe passive investments? Well,
look, I'm understanding how it's being syndicated, like you said, look, goal alignment with your syndicator.
Sure.
The GP having money in the deal. Pari passu from a capital structure. If I lose $1, they lose $1, right?
Sure.
Like, there's ways to mitigate that, but the average person doesn't understand what that is, and that's why we're educating people today to ask those questions. But from that being said, that's something I say to clients all the time. If you know how to do real estate and you can turn $1 into $2 faster than anybody you've ever met, keep doing it. But there's going to come a point in time when you're tired of doing it, don't want to do it, or can't do it anymore.
And probably still love the asset class.
And still love the asset class. So then here's the question you got to ask yourself. Do I want to start to build relationships with other people that can make money grow the way that I can make money grow when I don't have any more options? Or do I want to start building that relationship when I do have options and I do have choices?
Sure.
Right? So stick my toe in the water before I jump in and get soaking wet. So if you find somebody that you think will let you shift from an active to a passive role with a little bit of your money so you can start to stick your toe in the water and build the relationships, because what you said before is extremely important. Bet on the jockey, not the horse. What I learned a long time ago is in a good real estate deal, nobody cares about the jockey because everybody made money. In a bad real estate deal, a bad jockey will file bankruptcy, walk away and say, not my circus, not my monkeys. A good jockey will do everything he can to get that dead horse across the finish line. And that's when it really matters, the quality of the jockey. So learn how good the jockey is a little bit at a time and know that you trust them before you start to go whole hog. Right?
Love it. Great advice. Last question I've got for you, we're out of time, is you talk a lot about tax. I know that's what you're known for. What are some just common missed tax opportunities that real estate investors are sitting there investing that they're missing today?
Look, I don't think it's so much as what they're missing, because I think, unfortunately, the internet and TikTok has created a massive amount of tax advice. Most of it is kind of wrong, right? So everybody today is talking about, you commonly see people realize that they can do a cost segregation study on real estate and it creates losses, but many people think they can take it against active income, and that's not true. Many people are like the short-term rental loophole, and now I'm in the game, right? Many people think I can qualify for real estate professional status. There's many businessmen, and I'm not trying to be gender specific because I don't care, but you got a doctor, maybe that's a male, he's got a wife that's got a real estate license, she has one, and they try to qualify for real estate professional status on their tax return when she's never going to meet the 750-hour rule. So I see a bunch of stuff that gets used the wrong way. I think it's out there, but I don't think people really understand what it means, and they're just so desperate to take advantage of those opportunities that they will try to fit a round peg in a square tax hole, and it doesn't fit.
Bites them.
And it bites them, right? And then they think that they're good, and I've even heard unscrupulous real estate syndicators tell them that the losses from a real estate syndicate can be used against active income. I've heard it said multiple times, and I'm like, that's just not how that works. So, but what are they trying to do? They're trying to get investors into their fund, and they don't care under what premise that they get them there. And it wasn't written in the document. It was on the phone call when they pitched it to them. So there's, but you told me, no, I never said that. It's not in the documents, remember? So
And honestly, that's where I get asked all the time, why do I have so many doors? And the reality of it is I have a private equity firm that kicks off a lot of non-W2 income for me. And so why would I give it to Uncle Sam when I can go buy an asset with it, cost seg it, and offset my tax liabilities for a couple of years? It makes a lot of sense if you have non-W2 income, right? If there's non-W2 income involved, it's a really great strategy, right? And it's a way to build wealth.
Well, and the other thing you have to ask yourself is, hey, that's great, you're awesome, you're doing a cost seg, and I go, so is that going to solve all of your income tax problem?
No.
Okay, well, and even if they say yes, well, I go, is it going to solve your income tax problem next year? And I go, huh? Well, I go, are you going to buy a new building just like this one next year too? And I go, so you don't really have a strategy that you can use every single year. This is more of a one-off.
Sure.
So, like,
yeah.
And then they're like, huh?
Yeah. And then, so for you though, it's a more holistic strategy. So you might use cost seg, but then you might use a 1031 strategy. You may use, one of 20, tools in the bag that's going to help them with tax savings.
Absolutely. Look, everything is facts and circumstances dependent, right? About like how their portfolio, their life, their financial life looks. And you made a great point. W-2 income. Somebody asked me this at a thing I spoke at the other day. If the biggest change you could make is don't have W-2 income. Become a business owner. As I call your company and ask if you could be a 1099 contractor, right? Like just don't pay for employee benefits for me anymore. I got it on my own. Make me a 1099 contractor. Because now you flip that paradigm upside down of where you get to book expenses and things like that for yourself first and pay taxes on the income that's left over. That's one of the fundamental things you can do. If you're a W-2 employee of somebody else, like wealth, that is, forget real estate, forget anything else. The number one way to create wealth is to become a business owner in some capacity and earn your income in a different way.
I've heard that the greatest erosion of wealth is taxation. I mean, it's our greatest expense. So figuring that out, or putting your head in the sand and not figuring it out, is just not an option.
Absolutely true. I mean, look, at the highest marginal bracket in federal only, you're paying almost 40%. So 40 cents out of every dollar. So you make $1 million, 400,000 comes right off the top. You got $600,000 left to spend, right? That is a huge, that is the biggest expense at that level that anybody has. That's bigger than their housing. That's bigger than their car payments. That's bigger than sending their kids to college and all the other things, taxation. And so, figuring out how to address that first. Look, if you do nothing but save $100,000 in taxes a year over a 10-year period, plus being able to redeploy those dollars and getting like a 7.5% return on that, creates about $2 million of economic value over a 10-year period of money that you would have otherwise given to the IRS.
Right. That's a big number.
That's a decent number.
Yeah,
That's a decent number.
When the average person in America needs to have $2 to $3 million to retire. Right. Like, that's a big deal.
Yeah, that's a big deal. So tax smart moves make a lot of sense.
It's awesome. How do they get a hold of you and find out more?
That's a great question. The name of my company is Tax Alpha Companies. So you can Google me, Matt Chancey. I happen to be a certified financial planner. It's just because I'm in finance and I look at all this from that perspective. I don't function like a certified financial planner, but I happen to be one. But wrote a book with Forbes called The Tax Alpha Solution. So Google Tax Alpha Solution, Google Matt Chancey, Tax Alpha Companies. It all comes up.
Perfect. All right, appreciate it. Thanks for being on the podcast today.
Thanks for having me. I appreciate it.
For all the syndicators out there, I'm really sorry, but you can take it up with him. But
be a good syndicator. Just be a good syndicator. That's all.
Got it. Deal. Thank you so much to our podcast sponsor, CV3 Financial. When you're taking on a new real estate investment project, having a trusted lender is key. Count on CV3 for your fix and flip, rental, cash out, or rate and term refi needs. CV3financial.com/Think Realty. And if you haven't already signed up for a Think Realty Plus program, that's $14.99 a month, the most expensive thing I have to offer you, and it gets you a magazine on your doorstep, access to all of our conferences, our resident experts, calls every month, just a consistent barrage of information. We want to be your companion along the journey of your real estate investing journey. So thanks so much for being on the podcast today. We'll see you soon.